I just bought this property, but instead of it costing me money, I got paid $264,000. And no, this wasn't some quick flip or a risky gamble. I still own the property today. It's appreciating in value steadily, but if I sold it today, I'd pocket around $700,000 in profit. How is this possible? Well, I'm Eddie Galeen. I own over 150 investment properties worth over $100 million. And in this video, I'll break down step by step how I identified this winning property, how I figured out its true market value, and a strategy that put over $250,000 back in my pocket instantly. Now, this is the first property that I bought, 1 Melba Avenue in Sunbury. So you can see it's 1, 2, and 3, which basically means this property here is 3 properties in one. There's a 4-bedroom townhouse there, 4-bedroom, 3-bathroom, double car lock-up garage, and then you've got a 2-bedroom, 1-bathroom with a lock-up garage. Both of them have little courtyards that you can't really see. But this was an original house, 972 square meter block. Now, just from the first thing of why this property stood out to me when I was obviously searching online for more complexes to buy myself. So the guide originally was $1,080,000 to 1.165. I looked at this property based on where it was at. Again, we're in Sunbury in Victoria. And I looked at what other houses were selling for and also what other townhouses like these ones at the back were selling for. And it stood out to me right away that this was insane value and that to me it would have been priced incorrectly. Basically, that style of townhouse in Sunbury on its own would be probably $550,000 at least, maybe even $580,000. So as an example, $580,000, and then you've got this property right here, which the original house is still on about, say, 400 square meters or 380 square meters of land. That house at least be in the market probably $470,000 based off what other properties like that similar size, age, location are selling for. And then last but not least, you've got the 211 residence. So that's the two-bed, 1-bath, 1-car residence. Basically that in itself would sell for $450,000 at least, right? So 580 plus 470 plus 450, and these are conservative figures, is, how do I do this? 1.5 million. Basically, my first and final offer was 1.165. So I didn't even try to negotiate it down on that because I immediately saw value. I messaged the agent a link to the property, so he would know what property am I talking about. So I basically gave him the offer in text prior to even doing it. And we literally called him and closed the deal pretty much the next day. One of the important factors when you're looking at complex like this, and this can go down as a tip, if you've got 3 different properties or if you've got a block of units or a block of townhouses, one of the first things to do is look at the values individually. The next thing I would look at is the replacement value. In Melbourne and Sydney, the building cost with inflation and everything always goes up over time, right? People say the building goes down in value, the land only goes up in value. But to me, that is incorrect. It couldn't be further from the truth because 30 years ago, you could probably build a house for $20,000, $10,000. Now you can't build a house for much less than $500,000 or $600,000, depending on the house quality. So individually, they're already below replacement cost. So let's say that 4-bedroom townhouse that costs $650,000 to rebuild. And then the 2-bedroom, let's say that costs $400,000 to build. And then the front property, which is the older one, still to build a property of that sort, obviously if you built it, it would be newer. Well, that would cost $450,000 to build. So again, the replacement value is still 1.5 million, roughly. But to replace 3 properties, you need the block of land. And the individual land for 972 square meter block, I would say you're at least, worst case scenario, buying that land for 600,000. So you're at 2.1 million in terms of replacement total value. Those are some of the things I look at. And those are the main things I took you through in this video. So let's say the initial deposit, by memory, I did 20% on this property. Sometimes if it's more than X amount of properties on one particular title from a banking perspective, sometimes you have to put down a bigger deposit, but this property was 3 on one title. The particular bank at the time, I believe, was Commonwealth Bank. If they will allow anything with 4 properties and under on one title, they will classify that property as resi or residential as opposed to commercial. And then if it was like 5 properties on one title that you're buying, then you are likely to have to put down bigger deposit, like 30, 35s, or 25s, 30s, or 40% deposits. But again, this property was only 3 properties on one title, so it was 20% deposit. So 20% deposit of 1.165 million is roughly $230,000. the stamp duty, because stamp duty sucks and it's higher in Victoria than any other capital city, is 68,000. There was no fee for me to purchase it. Obviously, I didn't use a buyer's agent because I source the thing myself, because that's what I do and that's where my experience lies. The legal fees, I just say rounded up to about 3,000. Look, you can get sometimes a cheaper conveyancer for $1,500 or $1,000, but sometimes you have to pay like small fees on like mortgage, stamp duty costs, and just small stuff like that. So it's 3,000 rounding up, and a pest and building report, which is $1,500. Now, I just put that in there for this particular video and this particular book, but truth be told, I didn't actually even order a pest and building inspection report on that. If so facto, that would cost about $305,000 from a 20% deposit perspective to buy. That's roughly how much I put down to buy the property. That's section 2. The next thing is the expenses. So section 3, you can see I've just rounded up roughly $173 per week or $9,000 per year. Management fees, which is obviously property management fees, is about $6,000. So roughly, might be $2,000 per dwelling. Insurance premium, $1,500. Repayments were done off interest only, as per all why I recommend. That's just covered in other books, and it's covered it will probably be later covered in this book. But again, interest only is the way to go. When you're trying to scale, build your property portfolio from a time perspective, it's a mathematical equation that you'll be able to get there quicker if you go on interest only and are able to scale your portfolio quicker. And then the quicker you scale, the more money you'll make in the long run. Basically, that's the expenses and estimated market rental income. So the lower rental income, I think at the time it was around like $1,250, but it was obviously under rented. Those properties you could obviously see by how modern they looked. The higher rent per property was about $550 per week. So $550 for a townhouse when 3 working people could live there, even if they're earning $1,500 a week. Like even one person could afford that. $500, $550, and that's an affordable rent for just one of those 3 properties. So that's the estimated market return. Then you've obviously got the cash flow before tax. Now I'll take you through the after tax in there in a minute. Just as it is, the lower rent, yes, it might cost $75 a week or $100 a week to hold. But when the rent gets increased, and that's usually, when the rent is up for renewal, which I think this case was about 8 months. And again, I don't want people to look at this bit and the high, medium, high rent and be like, wow, he's making $275 a week or $15,000 a year. And that's how, if I get another 10 of those, and that's $150K a year. That's not what it's about. Cash flow, while I'm showing you these sheets, a lot of people have unfortunately looked at it from the wrong perspective. The main reason why I bought this property is not because of cash flow. It's because of I bought it at a significant reduced price based on what I believe the value was actually at the time. Because this is nothing. The cash flow there is, let's say, even if it was making $15,000 per year right away, you'd have to pay tax on that. It's not obviously including depreciation and other deductions, etc. But let's say you were making $15,000, like that can be gobbled up. If you need to replace a hot water system, there's $2-3 grand done. It's not about building a passive income stream through cash flow. It is about building a asset base of properties that has the amount of sufficient equity or cash there that if you sold the property or if you sold part of your portfolio, you'd end up with, $3 million, $4 million, $5 million cash at least, hopefully a lot more than that. Because when you sell a property after you keep for longer than a year, obviously you want to keep properties for as long as possible, but then maximum you'd pay like maybe 25% after you get the 50% capital gains discount. So even if I made $1 million on this hypothetically in 1, 2, 3, 4 years, yes, I pay $250K, but I net $750,000. And how long would it take in annualized years for cash flow to build up to $750,000? If that's $15,000, rounded down to 10 because of the miscellaneous costs, it would take literally probably 30, 50 years to get to $750,000 in cash flow. Whereas you can make that just by selling the property or pulling tax-free equity out of it and then using that for whatever you want. A strategy that valuers value sometimes multiple dwelling properties is the actual annual return based on the actual rental yield. And what I mean by that is usually very far regional town, the average rental return might be a lot higher than the ones in capital cities, but the average ones in capital cities of unit blocks would see them sell, depending on the location, would be between 4% and 5.5% gross rental return. As an example, the original rental return when I was buying this property, off the top of my head, was probably only I think it was rented out for literally $1,150 or $1,160 a week, which is significantly under rented. $1,160 per week times by 52 weeks in a year, $60,320 per year. Basically, 60,000 is being 5%, then that would be 1.2 million. Another way to get the equity out is to increase the rents. And those rents, if you look on like realestate.com and all that kind of stuff, like I could immediately see that the rents were under rented at that particular time, because I could see that townhouses and houses were on average renting for about 500 to 550 a week, right? And there's always a bit of leeway in that. But basically, let's say we get the rents up from, the lower, which is 1,300, and even lower than that, up to 1,650. That's still very affordable rental incomes divided by 3. So that's still only 550 a week. Like, a lot of people can afford $550 a week rent for a 2-3 bedroom property with that quality. It's not like in a CBD, like 550 will get you like a studio or one bed. But this is an affordable, blue collar area that is growing and etc. So we do this simple equation: 1,650 times 52 weeks in a year ends up being 85,800. And then let's divide that by 1.6 million as an example. And that ends up being 5.36. So just the other strategy, long story short, is if it's not strata titled, then I just work on increasing the rents. I work with the property manager. And how do I do that? Obviously, this is, to me, it's common sense. But a few quick tips is, obviously, when the property settles, you offload it to a property manager to handle. You get their, rental appraisal from it. You even be like, I've seen the other ones in the area. Obviously, it's rented for this. The leases might be up for renewal in the next 3 months, 6 months, 8 months. Usually you won't pick up a property that has a longer lease. And that just means you have to wait. So when it comes up to the end of that lease, your property manager basically just, talks to them, sends them an email, says, hey, look, other properties are renting for $550 per week as per these ones online. This is legit. And the rent has to be increased to this amount. And then it's obviously up to the tenant whether they, say, I agree to that, or whether they say, oh, look, we can't do it, we're going to move out. But again, if you're only increasing the rent to what the market value is and what it should be anyway, it's not like you're trying to, rip anyone off and increase it substantially above what it should be. Then even if the tenant says, oh no, I don't want to pay that, then they look online, they'll find other properties probably similar or inferior to the one they're already in and be like, to pay that, or then I have to go to move into another rental property, go through the cost of moving, which it might cost someone, 2, 3, 4, 5 grand, not to mention time, energy, effort, and all that kind of stuff. And the emotional part of actually having to move properties and then set up all the bills, set up the electricity, set up the water, set up phone, internet, all that kind of stuff linked to that property, and then get them mail redirected. Like, it is a nightmare to move. I've moved before. It was terrible. But once they're at that level, then you basically just will have to order a full valuation. I'll order a full valuation. Worst case, if for some reason I can't do it, which I will because they're already approved. Now, that's an important part. And again, I don't want people to think that the cash flow is important. In other books I've done, people have looked at the cash flow sheets like this and be like, wow, that's how you create the wealth. But that is not how you create wealth. The cash flow is a vehicle for how you can continue to build your property portfolio and how you are able to continue getting loans and buy property. The real wealth is made through the compound growth, as an example. So again, I've shown you that I bought the property at 1.16 million, and basically I already saw the value was at, let's say 1.5 to 1.6. So on average, people would be waiting 7 years for their property to increase that value. Whereas like, I'm buying the property, I already know it's worth that amount. I believe it's worth that amount. And just because another person or the seller's agent or the seller doesn't see it at that amount, and they maybe don't know, or they don't have the time to strata title it, or the time to wait. And obviously this was a deceased estate, so they obviously didn't have time, and they had to obviously just let go of the property, whatever it may be. There's 1,000 different scenarios of what made them sell it as it is. But to get the best sale price, if that was myself, obviously you got to have the time to wait. You either have to increase the rental income, because then the higher the rental income is, then it makes it more valuable to a potential investor to acquire and to pay a higher price. So again, if those rents were already at $1,650 a week, then I would probably have had to pay another $100,000-$300,000 more for it, because that rental return is more easily understandable to the average investor or agent that's listing a property. Whereas an agent or the average person wouldn't know the stuff that I'm talking about right here, especially with the strategy on how to recoup the capital and why that's the most important part of everything. So this is just how I analyze deals and how I've analyzed this particular deal. 3 properties on one title, and I'm literally buying it as we speak. It settles in a few months. I've made $400,000, $500,000 just by buying this property without waiting for the market to grow or anything like that. The first thing I want to talk about is, what is the strategy? What is the way that I can actually recoup that cash and get it back in my account? So I put $300,000 down. roughly in total to buy it. And now I want to buy it, settle it, and as soon as possible, be able to get that money back in my account, but also keep the property. In basic sense, I'm essentially buying the property and getting my whole deposit back, if not more sometimes a little bit less, but I've got the property for free after this exercise. So this is two ways that when I looked at this property, that I understood how to be able to get my cash back out. But basically, let's say we click on just the normal 1 Melba Avenue. Even though this is now 1/1, so if I were to get this valued by a bank through a desktop valuation as an example, or where a non-internal valuation, it would most likely come in at probably 700,000 because a lot of major banks just go off this kind of range. Now, this can be very correct sometimes. It can also be incorrect sometimes. But at the end of the day, if the bank value is at that, then it's really up to us to say, hey, look, are we going to take that valuation or not? It could be really low. It could be really high. But at the end of the day, like, they're only going to lend up to 80% of that anyway. So there's always a 20% variance. So even if they valued at 670, they're only going to issue a loan of that of 536 anyway, which I'd say the house at the prime is probably worth 500, 550. So let's say the front of the house is valued at 670 through a desktop because that's what RP data basically shows it as. Let's go to number 2/1. At this stage, it has a low confidence and 635, but let's be conservative and say they valued it only 500,000. So now we've got 670 plus 500,000, which, bear in mind, we're already at 1.17 million and we haven't even valued the last one yet. So desktop vals are usually the better types of properties to get because they have less humans involved in it. They're not internal and they just go off data statistics and what average properties are out there selling for. So now we're on number 3, the last one, the big one. It's 4 bedroom, 2 bathroom, 1 car. And look, here we've got medium confidence, it says 700,000. So 1.17 plus 700,000, literally we've got a total value of 1.87 million. So what do I do then? If, let's say, hypothetically get valued at those points individually, when they're strata titled, I can basically shop around. I could potentially take those properties to different banks. I can take one to Commonwealth Bank, hypothetically, one to Macquarie, one to another type of lender. And the reason why I would do that is because sometimes with a mortgage broker, you might have a broker that orders 4 different valuations on one property. And they say ANZ come in at this level, hypothetically 870, Commonwealth Bank came in at 850, and Macquarie came in at 1 million. So from that particular perspective, you take that particular property to the bank that had the highest valuation. And you could basically shop around to be able to put you in the best position to get the equity that you put in back out. Because again, I bought this property for 1.165. I put down $300,000 in capital to acquire it. And now I want to be able to take the equity back out and have the property more or less look after itself. It might cost me a bit, maybe 3, 4, 5 grand per year, but it will one day be neutral, one day be positive. And this one has pretty good cash flow anyway. So it's probably going to be neutral right away. But again, 1.87 million. And the equation and how I work it, how much you're going to get out of it. If I top all those loans up to 80% of 1.87 million, so I go times 0.8 like that, 1.496 million. And again, if we go back to the loan amount of where the property was at, 932,000, I could then technically top up the loan from 932 to 1.496. So 1.496 minus 932,000. And that gives me $564,000 out cash, when I've only put in roughly $300,000 to buy the property, which is insane. I bought the property, I kept the property, I refinanced it, and by strata titling them or getting them valued individually, and obviously that takes going through council and stuff like that, might be a bit of a pain in the bum, might take 1, 2, 3, 4 months, maybe 5 months, worst case scenario, but I'm able to turn $300,000 cash into $564,000 back in cash. Let's say it costs 30 grand for council fees or whatever it is, strata titling fees. I'm still netting, say 530. Let's say it costs worst case 60K, which is unlikely. But then I'm keeping the property, doubling my cash on cash return, bear in mind. So I've technically made 700,000 just by buying this property really, really well. So that's one of the ways I look at it. But now that you know how you can instantly get back the equity on an investment property that you originally put into it, what's your next step? I can't tell you how many times I've seen investors start very strong only to lose it all on their next investment property. So make sure to check out this video next, where I'll show you how you can turn $150,000 into 5 properties in only 2 years.